Okay, it's that time again, time for another market update, and there's a lot going on in the markets. But before we jump into it, I want to remind everyone that interest rates fluctuate. They go up, they go down, they change every day, and sometimes they even change multiple times within a day. I could speak to a client at 11 a.m. and quote one rate, and then speak to that same client again at 2:30 in the afternoon and quote a different rate based on changes that are happening in the market. It can go up, it can go down. So it's important to remember that. Now, to begin the year, rates were ticking down. Inflation was coming down. Again, inflation being the main driver of mortgage rates. The Fed rate hikes were making their way through the economy. January was a great month for the stock market. So things were hemming and hawing as expected, and the markets reacted kindly to that. The bond market was doing well because inflation was coming down, and the stock market was doing well because the expectation, or there was an expectation, that the Fed would stop hiking rates sooner rather than later. And that right there was the narrative. And then on February 3rd, the jobs report came out and it completely flipped the script. We covered it here. 500,000 jobs were created, which was almost 3 times the amount that the market was expecting. Piggybacking off that started this domino effect of other reports that came out that came in higher than expected or hotter than expected. CPI came out, and the numbers that they were expecting was that the CPI number would come out at 5.5%, and it came in at 5.6%. I know what you're thinking, just 0.1% is going to throw off the markets. Yes, because it's changing that story. Following that, the PPI numbers came out. PPI is the producer price index. It doesn't capture the headlines quite like CPI does, but it measures changes in production costs. And as production costs go up, ultimately those costs get passed over to you and to me and to consumers. And again, the expectation for PPI was that it was going to come in at 0.3%, and it came in at 0.5%. And then to put the cherry on the top, retail sales also came in hotter than expected. So for all these reasons, you're seeing a lot of volatility in the market. Now again, markets fluctuate, rates change every day, but it's important to keep these 2 things in mind. Number 1, this economic data doesn't impact jumbo rates nearly as much as it impacts non-jumbo rates. And number 2, at our company, Cross Country Mortgage, we have about 50 different investors who we work with. Some of these investors will move their rates less so based on what's happening in the overall market and more so based on their own internal supply and demand. So if they're a bank with a ton of business, they're inundated with too much business, they may raise their rates. Or on the flip side, if there's an investor who is starving for more business, they may lower their rates, irrespective of what's happening in the overall markets. So it's important to keep that in mind as well. And there you have it. That is this week's market update. If you have any questions on this or anything else related to obtaining a mortgage, please feel free to reach out. Thanks so much.